Hello everyone, welcome to the 20th episode of me learning how to trade using Forex. So in the last video we were on the intermediate course technical analysis on forex.com, and we went through understanding technical analysis lesson, and now we're currently doing the introduction to charts lesson, so let's get started. So introduction to charts. Charts are an essential part of any technical trader's toolkit. Let's examine how they work, the key types of chart, and how to read price action at a glance. Price v time. Any chart will always display price and time on its two axes. Charts are essential to a technical trader. Any chart will always display price and time on its two axes. Time is on the x-axis, time on x, price on y. In this way, a chart shows how a market's prices change over time. The chart shows how the market's price has changed over time. So got example chart here looks like, and price is on the y, time is on the x. And it's for Euro GBP. You can pick how much time to show on your chart. For a short-term view, you could examine a 5-minute or 30-minute chart. On a 5-minute chart, each point will represent 5 minutes of price action. Each point, so that means I'm guessing one of these will represent 5 minutes of price action. But if you're planning on positional swing trading, then you might want to look at something more long-term, from a week to a month or even a year. So what is this chart then? This chart is April is here, 12/2, 12/4, 12/6. So April the 2nd, the 4th, the 6th. Is that right? Yeah, because 31st is here, so that's March the 31st. Midday 12, April, midday 12, 2nd. So this is you can pick how much time you're showing your chart. On a 5-minute chart, each point represents 5 minutes of price action. So this is a week, no, not a week, a day chart then, because it ranges. That's April the 1st, April the 2nd. No, that means this is the 3rd, right? 2, 4, 6. So this must be a 3rd. What? That's a bit confusing. Okay. On a 5-minute chart, each point represents 5 minutes of price action. Right, okay, example. On this 10-minute Euro USD chart, so that's not that one. On this 10-minute Euro USD chart, each candle represents 10 minutes of trading activity. Oh, right, okay. So each bit is 10 minutes. Oh, right, okay. Each bit, actually each candle on a chart represents the specific chosen time frame, i.e. a 5-minute, a candle on a 5-minute chart represents 5 minutes. Of trading activity. On this weekly chart, each candle represents 5 days of trading activity. Yeah, I don't think this is the right chart, right? On this 10-minute Euro, 10 minute. So 9, 10, 20, 30. Oh, it is. So 9, 9, 10, 9, 20, 9, 30. On this weekly chart, each candle represents 5 days of trading activity. So 9, 9, 10, 9, 20, 9, 30. This is the same chart, though. These two. Yeah, I think this is the same chart. They got this wrong, maybe. Right, okay. You'll also be able to decide which price you want to see on the chart. Most are set to the mid or market price by default, but you can amend it to the bid, sell, or the ask buy price. So, whoops. Can decide what price is shown on the chart. Most are set to the mid, which is the market price by default. This can be changed to the bid, sell, or ask buy price. Types of chart. There are 3 main types of chart you can use: mountain, bar, and candlestick. There are 3 main types of chart to use: mountain, bar, and candlestick. Mountain charts are essentially line charts. They show you the broad price movements of a market over a given period. Mountain charts. Essentially line charts. Shows the broad price movements of a market over time, over a given period. However, there's a lot that mountain charts won't tell you. If you're looking at one with a 60-minute time frame, for example, then each point it will only show the last price reported in every 60-minute interval. To see what happened in that time, you have to check the shorter term charts. There's a lot that mountain charts don't tell you. If you are looking one with a 60-minute time frame, for example, then each point it would only show the last price reported in every 60-minute interval. To see what happened in that time, you would have to check the shorter term chart. Oh, right, okay, so only tell you the end price then, basically. Will only show you the end price for a given period. Bar and candlestick charts give you gives you much needed extra insight. Both will tell you the highest both tells you both shows the highest, lowest opening and closing prices of a market in a given period. The only real difference between bars and candlesticks is how they look. Both give you very similar information. Only real difference is how they look. Bars. Bars show price actions as a series of straight lines with two short lines coming off of them. Bars show price actions as a series of straight lines with two short lines coming off of them. So let's separate this actually. Bar, let's do candlestick. Let's do that. Shows the highest. Control C, Control V. Let's delete U. Delete U. Let's take a temporary image of here. Paste it in here. Whoops, that's not very small. I swear I had some images before this one. Where are they? How tall are they? Picture format 49.99. Right, okay, so bars. Not bars, just do bar. Candlestick. Candlestick shows a price action as a wider body with a wick line coming off of the bottom and the top. That's the wick line, and that's the candle itself. It is very similar to the bars. No, yeah, to the bars. It's just that center bit is a bit more. Let's see. 49.99. Yeah, it's just that bit's more. The candlestick is just more symmetrical, I guess. In the Trading Academy, we're going to be focused on using candlesticks. They're the most popular chart type, but choosing between bars and candlestick is really just a matter of preference. Try out both in your Forex.com demo and decide which makes it easier to spot price patterns at a glance. I think it will be candlestick, to be honest, because it just looks nicer in my opinion. Advanced traders may also use more sophisticated chart types such as Heikin, ASHI, Renko and point and figure charts. These can improve the isolation of trends and help predict possible future movements. So, advanced traders use more sophisticated ASHI, Renko and point and figure charts. How to read a candlestick chart. Candlestick charts show price action using three distinct parts: the candlestick's color, real body, and wicks. Candlestick charts show price action using three distinct parts: the candlestick's color, real body, and wicks. Upper wick, body, lower wick, and that's the color. Color. A candlestick's color tells you whether the price action over the period was bullish or bearish. The color tells you whether the price action over a period was bullish or bearish. A green candlestick denotes upward movement. Green equals upwards movement, meaning that the closing price was higher than the opening price. Red is going to be the opposite. Red is downwards movement, meaning that the closing price was lower than the opening price. You may also see uptrends represented by white candlesticks and downtrends represented by black candlesticks. So in that one, red is when closing price was lower than the opening price, right? Lower than the opening price. So the opening price is in the inside bit, so the opening price is the bottom bit, right? The opening price is that bit, closing price is above. So when the opening price is lower, no, when the closing price is lower than the opening price, isn't it? Closing price is lower than the opening price. The closing price is here. The opening price was here. Wait. Open is at the bottom. Open is at the bottom. Opens here, closes here. Opens here, closes here. Huh? Real body. Real body meanwhile tells you where the most of the price action was. Where most of the price was. Top and bottom of the body show the opening top and bottom will show the opening and closing prices. Yeah, I don't need to write that because that's already in the photo. On a green stick, so on a green stick, the market has opened lower than it closed. So the bottom of the real body will show the opening price and the top the closing. On a green stick, the market has opened lower than it has closed. Because green means upwards movement, meaning the closing price is higher than the opening price. So a green stick market has opened lower than it has closed, because the closing was higher than the opening. Yes, opened lower than it has closed. So the bottom of the real body will show the opening price and the top closing on a green stick. So the market, so the bottom of the real body will show the opening price and the top the closing. Oh, and the red one is opposite, right? Okay, I see. On a rectangle, opposite's true. So on a red stick, the market has opened higher than it closed, right? Yeah. Meaning the closing price is lower than the opening price. So the bottom of the real body will show the closing price and the top opening. Upper and lower wick. It's a little string. Using the upper and lower wicks, you can see the market's highest and lowest price over the trading period. So tells you the market's highest and lowest trading price. Oh, highest lowest price over the trading period. The upper is the market's high point, lower is its bottom price. Yep. Using these three elements, you can tell surprising amounts about the price action within a period. A candle with a long upper wick but a small body, for example, tells you that the assets rallied during the session but was then pulled back close to its opening price. Or, if a candle has no wick at all, then all the trading within the period is between the opening and closing levels. Well, let me just read that again. A candle with a long upper wick, so a long, let me just grab this, copy this, put that in the picture format, 49. So, what did they say? They said a candle with a long upper wick, so along that, but a small body. So if it's like a small here like that, but long wick, tells you that the asset rallied during the session, but was then pulled back close to its opening price. Or if a candle has no wick at all, then all the trading within the period was between the open and close level. So this is the rallied one. Long with a long upper wick but small body tells you that the asset. So this is its highest price, right? So if it's green, this is the highest price. This is closing price. This is opening price. The lowest price is pretty much the opening price. And green means what does green mean? Green means upwards move, meaning the closing price is higher than the opening price. So the closing price is higher than the opening price. Oh yeah, of course it shows in there. And high. So if I say, for example, this is a 5-minute period, then in that 5 minutes, it got up to a really high price. Then the closing price, it opened, it got up really high because loads of people either bought it, which increased the demand of it. But then when it was sold again, lots of people sold it, so the demand lessened and it dropped to low. Is it like that sort of that story? But then pull back to its opening price, close to its opening price. Yeah, so it got the hype and then it dropped. And this one, no wick, opened here, closed here, so it was gradually climbing. Yeah, okay, I see. Right, okay, that makes sense. Technical traders believe that patterns created by one or more candlesticks in a row can offer useful insights. So technical traders believe that the patterns created by one or more candlesticks in a row can offer useful insights into where a market is headed next. We'll cover this more in detail in the key candlesticks patterns lesson. Test your knowledge. What is this market's closing price over a trading period? So if it's a red one, then the opening is higher than the closing is higher than its then the opening is higher than its closing. So opening price must be at the top here, closings must be at the bottom, so 140. What is this market's low period over this period? Low, it's either one of these 2 points here, and that is 240. Okay, support and resistance. This is where they explain the support and resistance stuff they've mentioned earlier. Support and resistance levels are a core part of technical analysis, providing crucial insights into possible future price reversals. Okay. Support and resistance provide possible future price reversals. What is support? Support is a level on a market's chart that it bounces off of when in a bear trend. Support, a level in a market chart that it bounces off when in a bear trend. Say that an asset is falling, but there's a price that it won't drop beyond. Each time it hits that price, buyer takes over and the market rises again. This will be a support level. Asset falling in price, but there's a price that it won't drop beyond. Each time it hits that price, buyers take over, market rises again. When an asset drops to a level of support, sellers are unable to drive its price any lower. Buyers might feel that now is the right time to step in, which creates a reversal. When an asset drops to a level of support, sellers are unable to drive its price lower. Buyers might feel that now is the right time to step in, which creates a reversal. So shaboing, 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 and that is the support. Support levels are only appear in bear markets, though. As a bull market zigzags upward, it may hit subsequent higher support levels. Trends may hit subsequent higher support levels. In bull trends, you can spot support areas on charts of any time frame. They are sometimes referred to as a base or floor. Can spot support areas on charts at any time frame. Sometimes referred to as base or floor. What is resistance? Resistance is an area on a market's chart that it has trouble breaking through to hit new highs. Resistance is the opposite of support. When an asset hits it, sellers take over and sells its price back down again. Right, okay. So i.e. asset rising in price, but there's a price that it can't rise beyond. Each time it hits that price, sellers take over. Market drops again. So it hits boom, 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 boom. Like support, resistance levels can appear when markets are in bear trends as well as bull ones. Can appear in both bear and bull markets. They are sometimes referred to as an asset ceiling. You might also hear a market described as range bound, which means that its price is stuck between support and resistance levels. Range bound market means its price is stuck between support and resistance levels. So boing, 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 boing. Why are support and resistance levels important? Lots of traders use support and resistance to help them plan to when to enter and exit positions. Plan when to enter and exit. As a simple example, a support level that has been hit but not breached multiple times, so that's the bottom one, can offer a buying opportunity. By opening a long position near the area of support, you can earn a profit if the market bounces again, or you can open a short trade near the resistance level, so that's the top, to take advantage of any downward price reversal. Major resistance, major support, minor resistance, minor support. So it goes like that. Dush, 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 dush. Dush. So this bit is where you sell, and this bit is where you buy. So when you sell it here, and then say if it reaches like here or something, then you can buy it back. If you sold it for 100, you bought it back for 80, then you made 20 profits. And in here, if you buy it for 100, and then you can sell it here for 120, then you made a profit of 20 again. When you want to exit position, identifying the level at which price reversal is on the cards can help you maximize your profit or minimize your loss. Of course, support and resistance levels aren't absolute and can be broken. Often, support and resistance absolute and can be broken. Often when a market breaks through an established area of support resistance, it goes on to make a move towards the next one. This can lead to another trading strategy, opening a position on a market when it surpasses support or resistance level and trading the subsequent move. Remember though that nothing is guaranteed in the markets, they can be affected by a variety of factors. And that's why, fundamental analysis is important here to incorporate into the technical analysis, because then you can find out what these factors are which might affect it. So major versus minor levels. Not all support and resistance levels are equal. Minor levels will temporarily delay rising or falling prices within a larger trend. So this is a minor resistance, but at the end it still rises up. While major ones could stop and reverse the trend altogether. So, are equal. Minor levels will temporarily delay rising or falling prices within a larger trend, while major ones could stop or reverse a trend altogether. The more times the market bounces off a support resistance level, the stronger it is seen as being. If Euro USD struggles to rally up past 1.1965 for example, hitting that point but reversing multiple times, then a major resistance level may form. The more times a market bounces off a support or resistance level, the stronger it is as it is seen as being. Stronger it is seen as being, the stronger it is. Hitting that point but reversing multiply, then a major resistance level may form. Often the mindset of traders helps to reinforce support resistance levels. After USD bounces off 1.1965 a few times, a substantial number of traders might decide to place short market here. This reinforces the level further. If a market breaks through a major level, then it might go on to make a significant move in that direction. This is known as a breakout. If a market breaks through a major level, then it may go on to make a significant move in that direction. This is known as a breakout. That's almost everything, but there is one more thing to note about support and resistance. Support can become resistance. Often an area of support or bear move can morph into resistance if sentiment turns positive. Likewise, previous resistance can become a new area of support. Can become resistance. Resistance can become support. Take another look at the example above. So this one, right? Or this one. The minor resistance levels, the minor resistance levels in one move become minor support levels in the next. Minor resistance, so it goes here, keeps it back, bounces up, bounces down, keeps it here. Does it? Minor resistance levels. Resistance, stop it going upward anymore. Huh? When you're plotting a strategy after a price reversal, this behavior can be useful. By looking at the previous trend, you can gain insight into what might be ahead. Likewise, the previous resistance can become a new area of support. Minor resistance in one move can become a minor support in another. So this is a minor resistance. Hits that. Yeah, I'm not seeing that. A DAX rally has an upper limit of 13,500. The market hits this level several times, but sellers always take over. Is 1300 an area that's a resistance? The DAX breaks beyond 13,500, but then hits a new ceiling of 13,600. However, it also struggles to drop below 13,500. Is the market range bound? Because it keeps bouncing between the two values. Okay, I think we've done pretty well this lesson. Oh, we went through quite a few interesting stuff, reading the charts and stuff. Yeah, that looks all good. Alright, so I'm going to end this video here. I'll see you guys in the next video, which is trading with the trend. Thank you for watching, and see you later. Bye.